thank you very much, everyone, for coming this morning. I am Mark Roderick, and I'm happy to be here with Sydney and all you folks, many of whom I know. And thank you to our panel for joining us. I think the most important question, can you hear me? I think the most important question on everyone's mind this morning about crowdfunding is, what is crowdfunding going to look like under a Trump administration? So we know it's going to be huge, huge. It's amazing what it's going to be like, right? Okay. We know we're not going to allow funding for any foreign companies, however. Okay, so just
Sanders is a real crowdfunder, isn't
he is. Well,
$27 a pop.
he's the Title III is the Bernie Sanders of the crowdfunding world. Okay, so just a couple quick notes before we let the panelists introduce themselves. One, I just want to make a couple points from my perspective. One, this is just the internet. Crowdfunding is just the internet. I think Doug said in the earlier panel, E-Trade was huge. It was risky when it began. E-Trade was sort of the first step of the internet coming to the capital formation industry. But everything we're talking about at all these conferences is just more of it. It's just the internet. So is it going to continue? Is it going to grow? Of course it's going to, because it's just the internet coming to a industry, the capital formation industry, that is ripe for the disruption that the internet brings to every industry. Second, this is not just finance. Crowdfunding is not just traditional finance. It's not just dollars and cents. Crowdfunding, in its purest form, creates a whole new relationship between investors and companies, the consumers, the nonprofits. It creates this thing that we've never had before in capitalism, this relationship between investors and companies. So it's really not just finance. Part of it is, of course, but part of it is not. It's a whole new relationship. And the only other thing I will say in terms of the future of crowdfunding, just to start off, is I get calls from around the country and around the world about crowdfunding every day. And I will tell you that the level of innovation that people are thinking about out there is amazing. It is incredible, both brand new companies, brand new industries, and existing industries thinking how they might tap into the crowdfunding ecosystem. The amount of thinking and innovation that's going on out there is stunning. So that I think has a great promise for the crowdfunding sector. Okay, so with those introductory remarks, let me ask our panelists to briefly introduce themselves.
Starting with me?
Yes, let's start with you.
My name is Steve Sadler. I am the CEO of Allegiancy. We are a real estate technology company and we are in the middle of, hopefully, maybe toward the end of, a Regulation A+ IPO offering, $30 million raise.
I'm Joan Dromey. I'm the Senior Product Manager for Private Markets at ComputerShare. We're the largest transfer agent in the U.S.
Great. My name is Cherif Medawar. I'm a real estate fund manager. I'm an educator, and I'm the founder of CrowdFund Express platform.
Jason Paltrowitz, Executive Vice President, Head of Corporate Services for OTC Markets.
And I'm Blaine Mclaughlin, the Chief Operating Officer of ViaFolio, the private securities business line of Folio Investing, part of the Folio FN Investments Inc. clearing broker-dealer that we believe is the only one in this space so far.
Okay, thank you very much. So we're going to get into the questions. We have an intimate space here. So I would invite people, if you have questions, you don't really have to wait until the end for question time. Raise your hand, interrupt. A participatory conversation is always more fun for all concerned. So let me start with Steve. You guys have done. We're talking about, mainly this panel is about Regulation A, Title IV crowdfunding. So you guys have done an offering. Can you tell us a little about the offering, and can you tell us what you wish you had done differently in your offering, if anything, to prepare for it, to execute it?
Oh man, I don't think we have enough time to cover all of that. What do we wish we had done differently? I mean, our offering is a common equity in a real estate technology / real estate management company. So we don't own the buildings, we just make them perform. And we're selling common equity with no declared dividend. It's good old-fashioned. Somebody wants to get in and take advantage of the upside in our efforts to disrupt an old and stodgy industry. And so in terms of what I would do differently, gosh, there's so many things that we've learned. I think one of the challenges about being a trailblazer is that nobody really knows where the trail is. And so you're wading through the thickets, and you get thorns and you get cuts and bruises, and hopefully not too many arrows in your back. But there's some of that too.
And so how much money did you start off trying to raise, and how much have you raised?
Our raise is a $30 million raise, and we're going about it a little differently than perhaps other crowdfunding guys like Elio or some of the others. We're doing a hybrid offering where we have W.R. Hambrecht is a broker-dealer, is serving as our investment banker. They did all of the due diligence and underwriting, and they're building the selling group among traditional intermediaries, broker-dealers, investment advisors, RIAs, to market our securities to those people. And as a result, part of what happens is everything is kind of like quiet until about a week before closing, at which point all of those dollars go from being conversations you have to being real tickets or real orders. So the short answer is we have a very a robust selling group that W.R. Hambrecht has created, but we're not taking orders in the way that an Elio did. So it's not like you've got these benchmarks.
And who do you know who your investors have turned out to be?
Well,
Or is it a
know
different?
from-
I mean, or did they turn out to all be accredited investors anyway? Or
Yeah, I would no. The short answer is no. We did a Regulation A offering about 2 years ago, and less than half of our investors in that were
Okay.
accredited, and that's true here again. I think earlier the conversation talked a little bit about the need for income and for people's IRAs and/or their retirement accounts, and I think what we're seeing is an awful lot of interest from people who have trust accounts or long-term capital accounts, not so much the guy who's going to come in and trade. So we are seeing a longer-term investment.
and I'm sorry.
Can we just hear how much it's costing so far? Just
It's all free so far.
oh, perfect.
Yeah, it's like, why not
When
do
I
it, right?
invited, yeah,
Tell us how it works.
when I invited questions, I should have said it from everyone but Joel.
Except Joel.
Yeah.
No,
But-
I mean, it's a great question. I think, we happen to benefit from being a 10-year-old overnight success kind of company. We have a robust business that generates revenues and even those P-word profits. So some of our spending may or may not be the norm, but by the time we're done, I expect that we will have spent about $500,000 or $600,000 in the process.
And does that include placement fees?
No.
Okay.
No. I mean, commissions to broker dealers are an extra chunk that's more than that.
Okay, and with the benefit of hindsight from the feedback you've gotten from your investors and your selling team, do you wish you had issued a different kind of instrument? Do you get people saying, boy, if it had just had a coupon, if it had just been...
It's a great question, Mark, because I think that is a big deal. I mean, one of the challenges is, we didn't want to issue a debt security because we wanted equity in the company to create the flexibility and to build our balance sheet the way we thought it should be built. But I do think that if you are offering a security that has a coupon and you can demonstrably support that coupon through your operating business, that you have a much wider audience. It's not by accident that the debt, on-deck fundings, et cetera, have been the most explosive in their growth. People think they understand debt. They think it's safer than equity. I would argue many times that's not true, but that's how people think about it. And I mean, let's face it, people are lazy. They don't actually want to do the underwriting. They don't actually want to think new thoughts about new industries and new opportunities. And so they look for markers. They look for imprimaturs. They want the good housekeeping seal of approval on your deal. And that's where somebody like a W.R. Hambrecht comes in really handy, because they do have a reputation, they do have an existing audience, and they can kind of, you can benefit from that imprimatur.
Okay. Well, I'd love to pursue that debt versus equity thing, because I think it's a huge deal in our market, but we have a limited period of time. So we are here talking about Regulation A, so we have to talk about the Elio Motors offering, at least briefly. Who in the room is aware of the Elio Motors offering? Just about everybody. So, Blaine, I'm going to ask you to just give a brief overview of that offering, and then I'm going to ask you whether the offering is a good offering, whether it's a financially viable offering, and what you think how much impact you think the success or failure of that one offering is going to have on the Regulation A market. Can I ask you those questions?
No pressure, huh, Mark?
No, no.
Well, with the disclaimer of didn't partake of the Elio offering, I wasn't the platform underneath it, I can say as somewhat of an observer, they seem to do a fantastic job at mobilizing their fan base. So our friend Gene Massey here loves to use the term fan financing, and I think it's a good term for a consumer-oriented company that's leveraging its consumers to be investors as well. So they did a fantastic job at that. They had a good marketing firm to work with them on that. They made their online subscription process pretty easy. You know, I've heard from some folks that by making it a two-step process of first indicating interest, testing the waters, and then doing subscriptions, they lost a lot of folks. So I think a learning that maybe some other folks have shared with me is they'd rather get the offering qualified and have people come to the site once, subscribe, put in their conditional order, and be done, and so they don't lose people in a two-stage process. Later on, I heard the closing went pretty well. They were able to work through the escrow and that sort of thing. I've heard different stories on how difficult or not difficult it was for people to then deal with their shares. And you know, I'm not unbiased in this particular topic, being a clearing broker-dealer, but their shares were initially deposited at a transfer agent, a very good one, in fact. But at a transfer agent, they couldn't do anything else with them. So a lot of people wanted, and this probably goes to the psychology of, you know, the less sophisticated investor. They wanted to sell. You know, I've heard this is going up. I want to sell. How do I do that? And the process of moving what was initially private security into a brokerage account, not so easy, not inexpensive, not fast. And I heard a lot of people say there was some angst about that.
So
But yeah, please
I
pile in
actually
there.
followed the whole thing from start to finish.
Okay, terrific.
Paul Elio calls me almost every day now. So,
So you're going to say it was a terrific deal.
well, I won't. Look, it was the first one, and I think when you talk about some of the lessons learned, and we're talking about, you know, deposit of shares was certainly one, where if you looked at the first couple of days, you know, a lot of that was really more or less around people not understanding what was being deposited. And I think the transfer agent and the transfer agent role people don't think about as much as perhaps they should was kind of vital here in working through that and making sure that those shares were deposited. Within a matter of 2 to 3 days, the kind of hand raising like, oh my God, nobody can take these shares was kind of over. Those shares were deposited, and it seemed to have worked relatively seamless.
Do you think
after
that the fan investors bought to sell within 3 days?
No, and they didn't. And you know, it's interesting. You talk about, is it a success? And you know, again, we're right in the thick of it. So you know, you see a lot of articles that have been written that have said this isn't a success. They only trade 8,000 shares a day, or
It's an unqualified success. Anybody who says it's not a success is a
it's
bloody idiot.
completely successful.
They
So
raised
were-
capital. They crossed those hurdles. They blazed a trail. It's way easier for me because of all the stuff that Paul and his team.
They
have done.
raised, you know,
And
they
the
had
shares have traded up.
6,000 investors. They raised $17 million. The shares trade. The people that want to trade them can trade them. They've traded close to 400,000 shares since the offering.
And the price of the shares has gone up. Now, the bigger question
well,
maybe underlying this is
what is
Elio
the,
Motors
what
a
is the
great company?
What I
viability
will say,
of the
though,
company?
That's a
one of the
different
things you
question.
asked about lessons learned, and Blaine brought it up, is if they were to think back, a couple of the things. So the Test the Waters had them out at about 46 million. So I think they raised 17 million of the 46. Two of the things I think, if they were to say lessons learned, one was because of the nature of the investor. If they had kind of told people what their goal was and kind of had a tracking mechanism, I think they probably would have gotten more, because people were invested in it, and because you want them to reach their goal, I think if you had been able to follow that through, probably. I think the second thing was they had a lot of large indications of interest, and I think talking to the hybrid model, if they had had somebody picking up the phone, kind of calling people that had indicated 250,000, 500,000, investors like that want
want
an
some love.
institutional love, and I don't think Elio did that. And I think when you get to that hybrid model, they probably would have crossed that threshold a little bit.
An
a little
interesting
bit
point,
faster.
though, is that in the secondary market trading, after Elio closed, the fact that there was, call it $30 million of interest that had not crossed the threshold and become shareholders in the IPO, I suspect that was a meaningful part of why their shares traded up immediately. Because there were a lot of people who had information and interest in that for whatever reason, could have been on vacation, missed the memo, whatever, you didn't get into to the IPO, and they came in later. And so it's not all bad that the way it worked out for Elio could be very good. But I think
And can you tell us something about the prospects of Elio? Is there?
I mean, from a business perspective?
Yes.
I mean, I'm not going to talk about their business. I've been in the car. I've seen the car. We can all debate whether or not a three-wheeled car that gets 86 miles to a gallon for $6,800 is a good business. What I can tell you is Paul is passionate. To have a CEO that has passion and believes and has a plan, certainly as we talk about, I think somebody said the democratization of finance, right? Certainly up until Elio, if I had belief in his passion, I never would have been able to participate in an IPO of this nature, right? And maybe I could have seen him on TV or read about Elio, and certainly Paul's been all over television. The capital markets never, up until Elio Motors, would have allowed me to participate in that passion. And so in that respect, now if I am somebody that believes, and Beauty Kind or Allegiancy are the ones that are coming behind it, if I believe in that, I can now participate in the financing of that. For that, I think it's a unmitigated success.
Yeah, absolutely.
Okay.
I completely concur.
Do you want to ask a question?
Steve.
Curious because I look at the Elio.
Can you speak up, please, or maybe I should repeat the question.
Very curious about your assessment of the quality of the deal. I read the prospectus cover to cover. Yes, they were successful in raising X number of dollars, but it seems as though there was nothing but red flags throughout it. The company's in default of debt. They've got a note coming due in July, which will wipe out the liquidity that they raised. And the fact that they can only go to market with raising another $300 million, which they're hoping the DOE basically provides a loan to, is their saving grace. And so I'm curious as to how that deal, sure, maybe it's a passion play like Sarah mentioned, but that's a lot of retail capital going into a deal that seems as though it's DOA.
Well, okay, so the question is that there seem to be a few issues with Elio as an investment vehicle. So
Or as a company, right?
I don't know whether anyone wants to comment on that, or could that deal have been funded except for a fan base? No. That Elio would not have been funded except for a fan base.
That tells you that it is a success?
Well, Joan says that makes it a success
Because how is that different than any other investment market?
Well, and the beauty of what Steve was just talking about, though, is that the red flags were right there
disclosed.
Out in the open.
the offering circular. So if you read that offering circular and then made the investment, you had that information available to you, and you chose to make that investment anyway. And that's how it's supposed to work. It's not the SEC's job to determine whether a company is going to be a success or not. I don't disagree, Steve, with your analysis and the concerns. I mean, I've read the memorandum as well. Are there hurdles in front of Elio? Sure there are. There's hurdles in front of every one of our businesses.
Okay, yes, sir.
Does anybody think there's an underwriter in the country that would have underwritten that deal, number one? And number two, what's going to happen to
Well, that's the question. That is the question. And I would suggest it's not just Regulation A deals, because the press, right? The press is not out there saying, okay, this is a Rule 506C deal, and this is a CF deal, and this is a hybrid deal. This is crowdfunding, right? So if Elio turns out to have been a poor investment from a purely financial point of view, how is it going to affect our industry?
Yeah, let's talk about that though for a minute. Let's look at Tesla. Has Tesla been brutalized by all of the really smart guys in the business? I mean, every analyst I've ever read tells you what a piece of junk Tesla is. How's Tesla doing? They seem to be dominating the world. And so I'm not saying Elio is Tesla, but I am telling you that from my experience, and I've spent years on the institutional side in finance, these really smart guys at institutions, they ain't all that smart. They're not necessarily any smarter than any of us.
Well, I'm just going to ask one more Elio question, because I definitely wanted to deal with it, and as you can see, people are interested in that topic, so I did want to deal with it. But let me ask you a question. If the investors were the fan base, okay, and the investors lose their money, are they going to be real angry, or is this like you wrote a check to Bernie Sanders because, damn it, you believed in it? Are you angry that you wrote that check just because he ends up losing? I mean, is that what it's like? Is it purely a financial decision? Would you?
So with Elio, I don't think it was, and I don't think you're going to be angry, and I think you are, it's 6,000 people that believe. I think you were probably angrier if you were an employee of Lehman Brothers. And you lost all your money in that. I think you were probably pretty angry if you were an Enron investor, a WorldCom investor.
Or how about Wachovia Bank? You remember that
yeah,
one?
I mean,
so that this special thing, this special relationship between investors and companies, which is not purely a financial relationship, right? Just like the Bernie Sanders donor. He or she didn't do it because he expected a financial return.
Yeah, well, that may be...
He was investing in something he believed in. Yes, sir.
But these were not donors. These were investors. I cannot imagine somebody writing a check with an expectation of return, and then they get a default from the company, and they're going to be all happy about it because they're such fans.
Yeah, they're not going to be happy.
But that is the question. I think no one knows yet.
I don't think anybody was investing in this. The traditional IPO that's all institutional, where the investment is basically about how much money can I make once it's closed and I sell it immediately, right? I don't think anybody in these types of offering has that 3 to 6 month I'm getting out to make a boatload of money.
Well,
I think people go in with
this may explain though why you didn't get the big ticket guys,
maybe.
Right? So maybe the big ticket guys read the perspective and decided.
You don't know that nobody did that, right? But you're guessing, speculating that this is a fanboy investment.
Your comment about so-called fan financing, they've already exhausted their fan financing because they pulled in about $30 million of customer deposits from the fans with the expectation that they may get something. Those are the fans. They want to buy the product. They want to.
But a lot of those people invested as well.
They may have. They may have.
They did.
But
Okay.
back to the finance.
Okay, so very interesting. Yes, please.
I have a question, Jason. Out of all the investors that purchased it on the offering, are the bulk of them just holding? I mean, how many? Do you have any idea of how many investors have actually?
I don't know the details of it, but from Elio's point of view, they figure a vast majority of them still hold.
Well, and this question about fanboy investing, I mean, that would have suggested that Elio could have sold that offering just with a Facebook post. But in fact, how much did Elio spend marketing? I mean, that was one of the key aspects of that offering. It kind of drew up a veil of just how much money even a company with however many 25,000 or 250,000 Facebook followers, I mean, they spent a lot of money marketing that deal, right? I mean,
well, the ad agencies will take your money as long as you're doling it out. There's no hesitance on their part.
Okay, so let's move away from that, but on a related point. So, Joan, We just heard that Elio has thousands and thousands of investors now, new investors. These are not just 6 big institutions, lots of investors. So how do you deal with all those investors? How important will it be for them and for any company to have a terrific investor relations effort in place?
I think it's really important in this space. Investor education is a big issue, and it's going to continue to be one. I think that what happens for investors in things like this, as Jason said, you've got some degree of fans. You probably have some people that will be upset when they lose their money. But I think one of the things that I'm seeing in companies that we're dealing with is you've got novice issuers on one hand, and a lot of times you have novice investors, or investors that may not completely understand that they're not buying a fully liquid security in some instances. In Regulation A, there's some issues around the trading of the securities and who's going to do what and how. So I think there's education on all sides. For the issuers, they need to understand what they're doing and how they want to do it. I'm finding that one of the things that we have to focus on in our practice is kind of presenting issuers with choices, like what kind of path are you going to take? Are you going to act like a mutual fund and redeem shares? Are you planning to go on OTC? What are your plans? How do you intend to deal with the liquidity issue for your investors? And for the investors, I think it's really important that people understand if they're buying a restricted security, they need to understand how that works, and you're going to have to continue to put that in front of them and educate them about it. And I think for Regulation A, one of the things that I see that issuers get victimized by sometimes, and I know you're an attorney, so I'm just
Do you
gonna
think they're victimized by attorneys? Is that what
no,
you're going to say?
I'm going to tell you that in some instances, what happens is people get their, I don't know whether they get them off LegalZoom or what, but they get their bylaws and their articles and their memorandum, and they're stuck with paper certificates. And that's not always the best choice. And I think part of it is that's sort of a hangover of those are details that people aren't necessarily focused on. But in the long run, it costs the issuer and the investor in terms of convenience and sometimes money. So I think the
Well, isn't that
education
sort of
starts.
antithetical to internet-based crowdfunding, right? Paper
Yes,
certificates?
it
That's
is.
almost funny.
Yeah.
It's like something left over from the Stone Age. But I mean, I warn people when we're talking with people that are doing these offerings, I'll say you need to look at your articles and your bylaws and look at your memorandum and be aware of this and get it changed now before you really get stuck with it.
Okay, Cherif, I'm going to flip a tiny bit here, but one of the things that is striking me so far about the development of the Rule 506C market, notice, Sarah, I didn't say Title II. The Rule 506C market on one hand and the Regulation A market on the other hand is that the Rule 506C market is very much portal driven, right? When we think about investing in Rule 506C deals, we think about portals. We think about Fundrise or Patch of Land. So far, when we think about investing in Regulation A deals, it's very much a company-driven. We think about Elio. We don't, as much as Ron Miller would like us to, the first thing that comes to our mind is not, oh, that's a start engine deal, okay? And that is true across the board. There are a couple of portals that are, whatever, specializing in Regulation A. Ron's, Ryan Feet's Seed Invest, a couple other portals, but mainly this is company-driven so far. So why? Why is Regulation A so far driven by the company and Title II driven by portals?
Okay, well, I agree with you, but also you're always looking at 3 things. Number 1, the deal itself, the product. And number 2, you're going to look at the developer or the issuer. And number 3, you're going to look at the market positioning. So no matter what fund you're going to invest in, you're going to look at these 3 things, number 1. Number 2, I want to mention that a lot of these sponsors or issuers, developers, if you will, I deal in the real estate arena. So I think many of them are they don't want to deal with the SEC stuff. They want to go find the properties.
Everyone who wants to deal with the SEC, raise your hand.
Exactly. So what ends up happening is they're completely novice about it. They want to be at a distance. So they're either unaware, untrained, unable, or unwilling. So in my company, what I've done, the reason I do educations, we've been in the education business for 17 years, is I can tell you that the only way the crowdfund world will work is if you educate the actual developers and tell them, this is a way you can go about it. You can go with the Reg D 506B, the C, the Reg A+, and this is why each one would make sense. And here are the attorneys that specialize in these areas. You can be the best attorney for all. And for those that are new, what we're doing is we're co-sponsoring with them. We're saying, okay, so we already have a fund and we can have partnerships. We can co-fund, we can pre-fund, and we can list it for you on the CrowdFund website and expose you to the world. If you don't want to deal with these details, we have a shortcut that is legal, that is professionally done, etc. So now you talk about investors, you have two types of investors, the unaccredited and the accredited. The entire world has been everybody competing for the accredited, which is what, 7 million US people? 9 million?
8.5.
Okay, let's say 10, because people fake their taxes, right? So let's say 10 million
the upside.
accredited people that we're after. And then all of a sudden Reg A Plus goes out there and says you can go to the non-accredited qualified. That's like over 100 million people. But it doesn't have any meaning unless you go and educate these people and you tell them, this is what's out there today. You can go online, you can diversify by type of products, by region, by developer, and you can put your money. But if you're going to go to unaccredited, they say, well, these people are not going to invest because you're thinking of savings. You should be thinking of the $14 trillion that's sitting in IRA and retirement accounts. So the entire thing makes a lot of sense once you put the education part to it. Otherwise, it's not going to take off. And that's really what happened when E-Trade started going online. The reason they succeeded is because there was all these seminar company going out there pitching, we have this product, green lights, you buy the stock, red light, you sell the stock. But guess what it did to the market? It just completely changed the online trading.
Okay, and I do want to
stocks.
follow up with that question, but I want to focus again. Like you said, well, if you're an investor, you need to look at the developer, you need to look at all the due diligence materials. But in fact, that's not what people do, right?
Correct.
And particularly in the Rule 506C world, if you want to invest in some real estate debt, what you probably do is go to a site that you trust, patch of land, for example. You could invest in a patch of land deal sitting at your table in this seminar, and I've actually done that. And I admit, I didn't look at anything because, why? Because I trust that Jason and his team are vetting those deals. My question is, why is that not happening in the Regulation A world?
But I have an answer for that. And,
Okay.
and I think the primary driver the difference between the Reg A Plus company-driven and the 506C portal-driven is dollars. And so if you go to most of the portals, these are relatively small, particularly with respect to real estate, they're relatively small raises. I mean, if you're raising $1 million on a portal, that's a tiny little real estate deal.
Yes.
And there's no one doing a Reg A Plus for their company that's raising $1 million. Or if they are, they really should rethink it. But so I think that's your biggest driver, is that if I'm out with Allegiancy doing a Regulation A Plus offering, there are at least two things I'm thinking about. One is I'm building the brand for my company with everything I do in crowdfunding. So all of my crowdfunding effort serves two purposes. It not only introduces me to potential investors who hopefully will write checks in our offering, it also introduces me to potential clients in hopes that they'll understand enough about my business that maybe they'll become a customer.
And so if I can translate that into my brain, you're saying that as a company, if you're going to raise that much money, you're going to make sure that it's raised under your brand. You are not going to allow a third party, namely a portal. You don't want Ron referring to this as a start engine deal. You want this to be your company's deal. You want to be independent of a third-party brand?
I think
Is
that's
that
right.
a way to say it?
I think that's right. Although, as soon as I say that, then I have to ask myself about, am I being hypocritical? Because we are using W.R. Hambrecht's brand to help us. And so maybe part of it is that there's not a lot of brand equity in some of these portals. I don't know.
Well,
but I think the dollar amount is part of it.
You are being hypocritical. There's a
You got to get comfortable with that
lovely
early.
young lady, Georgia.
Yeah, I just was thinking, doesn't that hit the nail on the head? Isn't it that because these are bigger deals, higher dollar amounts, you're actually pulling in the traditional broker-dealer community to distribute the deal because there's enough money for them to get in
Yeah, I mean, I think that's the big driver.
Yeah, and maybe as the industry grows, you know, look at the public markets. Even very, you know, Facebook used underwriters, right? They didn't sell direct. So maybe as the market grows and the start engines grow and the seed invest grow, maybe that'll change. It's just an interesting phenomenon right now that people buy Rule 506C deals from portals. They buy Regulation A deals from companies.
What I think you're going to see that change, though. I think,
Okay.
Because Reg A is new.
well, and I think 506C, one of the challenges, I mean, we deal with, in our business, real estate companies all the time. And a lot of these guys are all Reg D all the time and have been for decades. And so 506C is still new to them, but they're beginning to understand that if I'm in a real estate business where I'm a perpetual capital raise machine, building my own brand makes an awful lot of sense. And so we may be partnering with a portal in the early stages, figuring it out, getting our feet wet, but eventually some of your more substantial players, I think, will migrate to their own branded platform.
That is certainly happening. Okay, now let's talk about, yes, sir, you have a question or a comment?
You know, obviously, with Reg A, you can go out to non-accredited investors, and you can go out to a lot of non-accredited investors. Does that scare anybody, having all those uneducated investors in your deal? And a lot of people saying, well, I didn't know it, nobody ever told me. Whereas most people like the idea of accredited investors because they understand the deal better, they think. So does it scare people that a lot of investors are going to be...
Well, this was definitely something in the beginning that the naysayers about the whole crowdfunding phenomenon said, no, companies are not going to want that dumb money on their cap tables. I personally always thought that was pretty much nonsense because my experience is that entrepreneurs want the cash. They don't really care where it's coming from very much. I think the experience so far has borne out that it doesn't matter if you deal with it properly from a legal perspective. But let's ask these folks.
Ask Blaine, because he's got 100,000 people in his brokerage, and I know he's doing Reg A deals. And how does he feel about all those non-accredited investors going into his deal?
Gene, your 1 million investors at $1 a piece scares us. Not
Why?
because of the
Why?
technology, but because of the servicing cost of servicing $1 accounts, $1 customers. And whether that's a clearing broker problem or a front-end broker problem or a transfer problem, there is a cost of servicing customers, and that cost generally is paid by the issuer. So issuers tend to care, I think, about very, very large numbers. But I think, and this is speculation, most of the Reg A offerings will have thousands of investors, maybe tens of thousands.
Yeah.
And that's okay. It's particularly okay if that's not their only investment.
Exactly.
Because I think, and there are service providers, I'm one of them, that is very explicitly focused on enabling people to be diversified in their portfolio, not to make one bet and walk away. So if you make 100 or 1,000 small bets, that's a portfolio. If you make one gigantic bet, that's Vegas.
Well, it's also, if Elio, for example, no one wants $100 investors because there is a per investor cost. But if those investors become car buyers as a result of being an investor, that changes the calculus, which is part of kind of the whole thing. But so let's talk about.
Oh, but let me, if I may
Okay.
add. So the issuer really has to do some type of education, like Patch of Land is now leaning toward educating the consumers out there because they want to go out with some Reg A+. That's number one. Number two, the issuer will have to put a minimum. For example, we have a minimum of $5,000. And the SEC created some guidelines for the new regulation, the CF coming out. So they're also trying to create some guidelines to protect the little guy, as in the financially not so sophisticated, if you will. But one more thing is, really, the key thing when you look at the history of complaints for the SEC has been on the liquidity issue. Somebody gave you the money, they don't have a lot of money, and now they want out. They don't want to be stuck for the 5 years when you're going to reposition the company or the apartment building or whatever. So what an issuer has to do is they have to put in there that they can buy back the shares, or they can make some effort on going after retirement money, which is more patient money than money from savings. So anyway, those are my 2 points.
Okay, so
Expand on that a little bit. In And that, and roughly, self-directed individual investors, you could call it about 10% of the dollars out there. 50% of the dollars in IRAs, and an overlay of 80, 90% of the dollars are advised, RIA broker advised. So part of bringing not just more people, but more money into funding these companies is creating processes and systems that actually allow registered investment advisors and brokers to be comfortable incorporating what is in effect an asset class that wasn't previously available, whether that be taxable dollars or IRA dollars.
Okay, so this is exactly where I would like to take this conversation. Marketing, how do you bring these 100 million potential investors into the market? So I'll start with the question to ask you to expound a little on the traditional financial advisors, my Morgan Stanley financial advisor. Are those folks going to be participating in this market, sort of pushing their clients in? If so, why? What's going to be their financial incentive? Or are they going to be the middlemen who get, you know, the internet just disrupts their business model? So just as, here, Blaine, just as one avenue, are those folks, the gigantic existing financial advisory industry, are they going to start funneling people into these deals?
I think it's very early to say that, but we've started to see people coming from all different directions. We've heard from advisors, because we support over 500 advisory firms, that their clients have come to them and said, I want some of this, I want some of that, I want some lending club notes.
That is how it's going to happen.
Okay.
But
good.
we've also heard from advisors say, I want more yield product, and that's what I need for my portfolio, and yield products aren't available in the publicly traded securities, so what do you have in private? So
Well, that
it's come
goes
from
back
both
to what
directions.
we were talking about earlier, the structure of the security. If you can legitimately offer a coupon, that opens up a whole nother world. But in our experience working with W.R. Hambrecht in getting broker dealers interested in a Regulation A+ IPO, the thing that, and it mystifies me even still, but the thing the broker dealers care about is all this back office hoo-ha you guys do. They're worried about all of this clearing and trading and deposits and certificates and how do I get this done? All of that stuff is literally the most important thing, because if we can't answer that question in a way, and thank God I'm not doing it, or my answer, I know what my answer would have been, but if we can't answer that question in a way that makes the broker dealer feel like this is a normal security, you're
okay.
done.
Well, this is Jason. I'm going to ask you this question. So normally, what the internet does when it comes to industries is it displaces middle persons. So, for example, when you made your reservations to come to this conference, whether on a train or a plane, and you got a hotel, did you go through a bricks and mortar travel agent? Most of you, nah. No. Right? You went direct to the airline or to Amtrak or to the hotel. Because that's what the internet does. It connects buyers and sellers. So in crowdfunding, is that what's going to happen, that investors, as they hear about it from their neighbors, are just going to start buying these securities directly? Or is it going to have to go through the existing middlemen structure?
So I think,
or both?
I think we see that already in the secondary markets. I mean, I don't know that Reg A Plus is going to be this big game changer. You know, if you look at who invests in sub $500 million market cap companies, it's 85% retail investors, right? You're not getting the large institutions. And those people are the ones that have their money managed, you know, their IRA and their kids' college funds are managed by Merrill or Morgan, and then they have their E-Trade account or their Scottrade account or their TD Ameritrade account. And they're making those investment decisions kind of on their own. You know, the age of somebody picking up the phone and calling somebody to say, you should buy this, that was over 20 years ago. And I don't know that Reg A Plus deals are going to, you know, that's the big game changer in that. Those people are making those investment decisions on their own, on that pool of money that they put aside to do their self-directed investing. And I think, you know, with Elio and the deals that follow, is you're not going to see anything different. I think it's going to be the internet and the word of mouth and you know, the game changer, as I said before, is that what we've been talking about up until Elio was used securities, right? It was the used security market that you could buy in the secondary markets. What we're talking about now is just transferring that to the new security market in a mini IPO type type operation. But that's really not, somebody at an Edward Jones office picking up the phone and calling 300 people and saying, you should buy this. It's the phone ringing and him picking up the phone and saying, I'd like to purchase that for my account.
Well, and take that further, make it a security you can buy in your online brokerage account.
Right. Okay, so
Mainstream these securities.
tell us how that
And a
works.
security that you can see in a secondary market where you can follow it. I can follow Elio on my iPhone.
But this is a question of timing. So in our view, you have initially, which is now, right? These are brand new. Elio didn't even really try, or Elio, I would say Elio, didn't even really try to get broker dealers involved. And in our efforts to get broker dealers involved, the answer 9 times out of 10 is, gosh, this is really interesting. We're going to wait and see how it works out. And so part of what has to happen is some deals have to get done and then trade, and then they find their way into the TD or the E-Trade account, et cetera. And that's happening with Elio, right? Because it's OTC. You can trade it in those accounts. You can custody it in street name. You can do all of the things that would be normal.
And every one of these broker dealers is looking at the next 10 years and saying, how do I capture millennial money? And where's millennial money going to come from? Right. It's going to come from this.
Yeah, and it's
and
the biggest,
right?
It's the
And
biggest
so you're going
intergenerational
to
wealth
create
transfer
the
ever.
infrastructure to capture your next big investor base.
Yeah, but if you're going to just rely on the broker dealer sending you the money as an issuer or as a platform for me, I think it's going to be a problem, because sooner or later they're going to say, well, we're just going to have our own platform as well, and we're going to eliminate all these other crowdfund websites. So the key here is to really realize that the crowds have their money with the brokerage firms. My job as a crowdfund website is to get their money out of these
there.
brokerage
Yeah.
firms by educating them and telling them, you can go direct. And you don't have to go to that middle person. Well, soon enough, that middle person is going to compete with me. So that's when I'm going to cooperate. And then we're going to have a monopoly. If you are going to succeed, just like the Google. Google was not the first one. Google came afterwards, but they did such a better job. They first copied, then they innovated, then they created. And nobody can catch up now. Same is going to happen in this space. It's going to grow very big, consolidate with a few, and then... So the key, I go back to, for instance, how am I going to get these crowds to put their money with me? I have to dedicate personal money, $2 million we put aside. We're going to start going around the country and doing these 1.5-hour presentations in hotel banquet rooms where we put newspaper ads. We go on the radio and say, come over. We're going to show you how you out there with $5,000 can invest in the new hotel coming right next to the airport, the Hilton by, by the Miami airport. And you're going to participate and become part owners. And we're going to fill up these banquet rooms. In every market we'll see about 1,000 people. I've done it for 17 years. I know exactly how it works. And these people will become immediate investors on the platform. And we're going to get their investment money. We're going to get their savings. We're going to get their retirement money. And that's how the broker dealers will have to adjust to us.
And have you seen, as the millennials begin to earn some money and so forth, and we all know millennials spend all their time online. So have you seen the way you market to investors shifting from hotel banquet rooms to social media?
Yeah, absolutely. But the social media is still, you see, to raise capital, you have to have some one-on-one. If I would love to just put it on a portal and somebody's going to see it and click and say, I want to buy. I'm not IBM. I'm not Amazon to raise money that way. And no new issuer is going to be able to do that. So I have to show up face-to-face. I raised $100 million face-to-face. When other people are saying, well, this is Reg D 506B, you have to have established an existing relationship, all these regulations. You talk to every attorney, with all due respect to attorneys, they tell you all the problems you're going to have. You're going to die over here, you're going to die over there. Well, okay, just tell me where I'm not going to die so I can go through that little alley and raise the money legally and ethically. And we did it and raised $100 million, and now we're ready for the next thing. And
did Elio need to speak, not obviously to every investor, but I mean, you hear this all the time.
So
that
they didn't speak to any investor.
They didn't speak with any investor.
No. I mean, Elio was really all online, and they used CrowdFund X as their media company,
Yes.
and to the extent people were talking about cost, I think they said it was 5% per million. I think is the number they use for marketing costs.
Okay, but they attracted people through their marketing. They didn't talk to investors.
No, they were very targeted and they were very smart. And the CrowdFund X people were very smart. And we're in the age of the internet, so the way that you get data and use data to target people is a whole lot different than filling up hotel banquet halls and the face-to-face.
So what's the coolest way that anyone here has heard about marketing any of these securities? I mean, I don't have any stories myself, but does anyone here, are there marketing people here? Are there marketing people here today? Okay, you're a marketing company. What do you think is the most effective way to market these securities?
Well, it's not a quick, easy answer, but in a quick summary, there are things that a company can do, like contests to draw crowds. If they have something that they can give to people that people would want to draw them in, that's the first thing you can do. The other thing is, Media Shares has, one of our suppliers has 1 million opt-in emails, and they only charge you by filled out forms. So usually when you send out emails, you only get anywhere from 10 to 20% open rate. So if you've got 1 million emails, you really only got 200,000. Now other ones not being open. But if someone is paying per open rate or per filled out form, that's very efficient.
And are folks like you out there right now going crazy trying to build databases of potential, yeah.
Of course, and they're building databases like of accredited investors as well as non-accredited. But the issue is, how do you reach those people without paying a lot? I have a client that just spent $10,000 on an ad campaign by putting these ads all over Facebook.
Gina, I think this is also where you can start to tap into the existing financial network that's already out there. All these broker-dealers who've been spending decades building up customer bases would like to distribute these products if they're able to put it through pipes that they understand.
And take
very
take
cheap,
a piece
you
of
can
the
give
action.
for
There's a cost for that.
And he's got 100,000 investors in his brokerage. That would be the first place.
The problem with broker dealers is the money will always go to safety and what they understand and the highest returns. So it's just so hard for a new issuer with the Reg A Plus to convince a broker dealer to really send me the money. It has to be a huge incentive for them to do it.
Okay.
So you have a bias-based incentive. Pardon me?
Commission.
Exactly. Yeah. Put a glitch in their head with the commission, then they'll send you the
I
money.
think you're specifically talking about brokers who are selling product to their customer. I'm definitely talking about those, but I'm also talking about the millions of self-directed investors that use a brokerage account as the vehicle.
Right.
So, for example, through my firm and through all of the broker-dealers that sit on top of my firm, you could put your Reg A offering, and many others, out in front of all of those self-directed investors and let them know it's there, and have the good marketing-produced videos that's going to help sell the product, much in the way that Elio did.
So if you don't mind me asking you, will you be able through your platform kind of control and manage the CF regulation that will say an individual cannot invest more than so much in a year?
Of course.
You will.
Whether
That's
it's
very
Reg
important.
CF or
That's-
Reg
that's
A or
crucial.
every broker, well, I wouldn't say every. Our broker-dealer and the broker-dealers we work with make sure we're in control to meet all of the regulatory and legal requirements that are placed upon us, which are numerous, but they're doable, and technology helps a lot.
Very good.
Joan,
Yes.
education. What's your recommendation to go out there and educate all these investors who need to be educated?
I think that most companies who engage in these types of offerings are going to have better than average investor communication. Because if I invest in something like this, I'm new at this kind of thing, it will be better for everyone if issuers kind of take the initiative and be proactive in their communications. I think real estate companies in general are pretty good at this, because you'll see people that have been doing syndications for a long time, they tend to do quarterly outreach and they let people know how the projects are going. They get out in front of someone coming to them looking for information. And I think that will be really important in this.
So how does a real estate company, because as we all know, 90% of crowdfunding is still real estate, I think. How does a real estate company that has already an investor base, they've been raising private funds for 3 decades, how do they, from an educational point of view, start to expand that capital base, through an online presence? They create their own platform, only their deals. They start off marketing just to their own base of investors, sort of using the platform almost as a customer relations platform. And
Yeah.
how do they start to then build and go beyond their existing investor base?
I think if you take a look at what you described is the approach that I think Fundrise has taken. They're a DC-based company. They've been doing real estate for decades. They actually, like his company, did a couple of old Reg A offerings when most people weren't doing that. But I think what they have done is tried to expand on their existing base. They haven't gone to the broker-dealer community, which Steve's company has done, and I think that is going to be a key point. I think it's a key for broker-dealers also, because if you look at the amount of capital that goes into private companies, it's a lot bigger than what gets, what goes on elsewhere in certain ways. So I think that there's a lot of opportunity here, and I think broker-dealers haven't quite come to grips with it's not traditional, it doesn't work the way all their other stuff does. So as Blaine has said and Steve has said, the broker-dealer key is they want to be sure that these securities are normal from their point of view, that they can move the shares electronically, that they can be in street name, that they can see everything that they need to see. I think there's opportunity for broker-dealers who figure out how to play in this market, but I also think that people are concerned that their margins will be compressed because the due diligence is on the broker-dealers. And I know I've been at conferences where people will say, well, if it becomes that I can't get 10% money out of this or whatever they're looking for, then I'm just not going to do these deals anymore. So there's some of that going on. And I think that the portals, going back to what Cherif was saying, I think the portals right now represent competition and disintermediation for broker-dealers. People get very uncomfortable with things like that, and I think that there's a lot to be worked through there. And I think what he described is true, that you'll see some consolidation. You'll see some portals will succeed and attract and become a name brand and probably partner up with a broker-dealer network for increased distribution. I just think that we're in an era where there's a lot of change going on, and it's kind of early to do a lot of predicting. But I do think there's a lot of educational opportunity, and whoever can figure out the right pathways and educate the issuers, the investors, and the broker-dealers appropriately is going to work out pretty well for them.
We're in a power law world, right, where Google dominates and everybody else cleans up the crumbs, and that's, I think, going to be true in the broker-dealer world, just like it is in the portal world. You've seen an enormous shrinkage in the number of independent broker-dealers in the last 5 years, and FINRA's clearly trying to kill the small independent broker-dealers, and they're not as forward-thinking and innovative as they perhaps could be. And I think that the disintermediation that we're talking about here with Reg A and with portals is going to hurt a lot of these broker-dealers. But some of them are getting on board, and those few are going to prosper enormously. Because I think when we talk about the generational shift, we have the largest wealth transfer in the history of the world is happening right now. As boomers move.
You mean from Reg A issuers to their attorneys?
Yeah, that too. And then you have millennials that have a demonstrated antipathy toward advisors. And so it's not that they just don't have one, they actively don't want one. And that's different.
Pardon? We're done? Okay, I'm sorry. Okay, so I guess, I have a question, but does anyone from the audience have a question? So I'll ask you this question, Steve, and we can just end there. Is Regulation A a big private offering or a small public offering?
Yeah, I think it's really a small public-private offering because if you
wasn't one of the choices.
if you look at Reg D, these are billion-dollar
answer
offerings.
the question.
So it's a small private offering. No, wait a minute. What were my choices?
Never mind. And on that happy note, thank you very much for your time.
We'll be back about 10 minutes.